In investing, risk and reward are inseparable partners. Generally, higher potential returns come with higher levels of risk. A savings account is extremely safe, but it barely earns any return. Stocks offer much higher long-term returns, but their value can drop significantly in the short term. Speculative investments like individual startups or cryptocurrency can produce massive gains but can also go to zero. This relationship exists because investors demand compensation for taking on risk. If a risky investment offered the same return as a safe one, no one would buy the risky option. The extra return that risky investments must offer to attract buyers is called the risk premium. Your risk tolerance has two components: your ability to take risk and your willingness to take risk. Your ability depends on objective factors like your age, income stability, net worth, and time horizon. A 25-year-old with a stable job and 40 years until retirement has a high ability to take risk. A 60-year-old relying on their portfolio for retirement income has a much lower ability. Your willingness is psychological. How would you feel if your portfolio dropped 30% in a market crash? If you would panic and sell everything, your willingness to take risk is lower than you might think. Be honest with yourself here, because overestimating your risk tolerance leads to poor decisions during market downturns. The smartest investors don't try to eliminate risk, they manage it. First, diversify across asset classes so no single investment can ruin you. Second, match your investments to your timeline. Money you need within 5 years should be in safer assets like bonds or money market funds. Money you won't touch for 20 years can handle the volatility of stocks. Third, consider dollar cost averaging, investing a fixed amount regularly regardless of market conditions. This reduces the risk of investing a lump sum at a market peak. Fourth, have an emergency fund in place before making risky investments. This prevents you from having to sell investments at a loss during a personal financial emergency. The goal isn't zero risk. It's taking smart, calculated risks that you can live with. Risk versus reward. In investing, risk and reward are inseparable partners. Generally, higher potential returns come with higher levels of risk. A savings account is extremely safe, but it barely earns an E.